Yes, it's next Friday. That was going to be my other, a week from this Friday, yes. That was going to be my other opening thing. Guess how many days of class we have left? 10. And really, whatever, 8 class days, right? So, and one of those is the final on Friday, which will be an in-class final. You can have a calculator, but no other assistance. So, and that's worth 25% of your grade. And that's why actually doing your work and coming to class, taking good notes, or if you miss class to get stuff on the board, all that's going to play in. So we'll have a review, kind of a review day on Thursday before the final as well. So investing, fun stuff here. So let's start off with, we're going to do the discussion questions, but I first wanted to look back at the first video just to kind of get our brains flowing. And what was this picture talking about here? What was this picture talking about from last time? Anybody remember? Looking for a big D word. D. I'll give you a hint. It's up there even. What, Hannah? Diversification. Yes. So diversification. What did that mean? What are you doing if you're diversifying your portfolio? More than one thing, more than even one type of thing, right? So definitely not like a single stock where you're buying just one Apple or GameStop or whatever. So you're not only doing that, but you're not buying like, let's say, all the tech stocks, right? So let's just say there's 300 tech stock companies. To buy 300 tech stock companies might be a good idea as part of your overall diversification plan. But you wouldn't want all your eggs into the tech stock basket. Why? Why would you not want everything in the tech stock basket? In case it crashes. So you guys are, I don't think we're even born yet, or maybe some of you were, I guess. How many people were born after 2001? 2001 or 2002 or later? That's pretty much everybody? Okay. So if you were alive, you were just maybe this high during the dot-com bubble. So it got freaking insane in 2001. Tech stock, people basically didn't even know how to use a computer back in 2001. I don't know if you knew that or not. But it took us a while to get to that. And all of a sudden, apps started coming out and different types of technology with use of the computer. And Silicon Valley just went through the roof. So it's called the dot-com bust because they were coming up with new websites of, doggy.com. And it was the greatest thing. And basically, people just jumped into it not really knowing much about it, just like GameStop kind of, and pushed the prices of a whole bunch of dot-com companies way through the roof. And then that bubble popped. And the fallout ended up being ultimately a small recession after 2001. But so don't put all your eggs into one company. Don't put all your eggs into one type of company, one industry. So we're going to be buying like 1,000 companies at once. And I'm going to teach you how to do that. The materials are going to teach you. It's not special Russ McCullough knowledge. It's just the way that you become millionaires if you want to do it. If you want to put your money in a place where it's going to systematically churn out a rate of return, probably somewhere between 8 and 12% on average in the long run. My portfolio that I do exactly what we do in this book, I got 28% 3 years ago or so, 16% last year. Sometimes it might go down to 3%, right? So it goes up and down, up and down. So the idea of the up and down can be partially seen with the S&P 500. Does anybody know why we call it the 500, S&P 500? S&P stands for Standard & Poor's, which is the name of the company that originally started tracking this. So Standard & Poor's 500. Anybody know why we call it 500? It's the 500 biggest companies. So according to market share. So according to a market capitalization, basically the the size of their company. It's big, well-capitalized companies. So these are the top 500 companies, and so it's used as a benchmark. And what they've done is they've essentially followed these 500 companies to see what's happening to their stock price over time. And here I've got 5 days highlighted. So this is right off Google. And you can see that in a shorter period of time, you can't guess what these stocks are doing, right? I mean, if you were to try to make money in the next 5 days on the S&P 500, you are basically rolling the dice. It's like putting your money on black or putting your money on red. It's pretty much like this. It's going to be the luck of a draw. If you happen to bet here and it goes down, you lose. If you bet here, you won. But there's no good part to gambling like that. That's not investing. We're thinking long-term investing in this chapter. And so what is baby step number 4? Not 8. Not 8 steps, 4. That's the investment one. Yep, that's what I'm trying to pick on. How much are we putting? 50% of our income. 15% of our income into long-term retirement. That's what this chapter is about. That's what we're going to look at. Now, check this out. As I start to balloon it out, 1 month looks a little better, right? 1 month looks a little better. 6 months, and the market's been good, by the way, for a 6-month period. So this is not usual. It's not always like if you go back 40 years, it's not down here. There would be some ups and downs. It's been pretty good. Year to date, I'll skip year to date. Here's 1 year. And you can see 1 year ago, we did have quite a fall from boom here and then up. What was happening about that time frame right around here? What was happening around here? Corona, right? We got the virus May 20th, so here we're in the March 17th time frame. So do stocks, change according to the external environment? Of course, right? We're seeing that right here. People's optimism about the market, and so they pull them out of some stocks. So here's that 5 years, and here's the max. And so this is just the max for this particular chart. Back to 1982. So 1982 to today is how many years roughly? 82, 92, 2002, 2012, 2021. How many was that again? 82. So then we got 92. 40. That's a little strong, right? Well, 40 years. Let's do it together here. 92 is 10. 92. 2002 is 20. 82 to 92 is altogether. 82 to 92 is 10. Then up to 2002 is 20. Then up to 2012 is 30. Gosh, you guys are sleepy here. Nice and loud on the last one, right? Then up to 2000, let's just call it 22 to keep it easy since we're struggling. So we're up to 2022, 40. 40 years. So think about your age right now, and think about where you want to be 40 years from now in terms of your wealth. Had you been this person here, you would have invested at 126. It's fair to look at this way in terms of the percentage change. In 1982, or 82, 116, and now it's worth 3,886. Everybody pull out a calculator. So how much has our money grown by then? What is the percentage? This is going to be enormous. I mean, most calculators can handle it. I could do it a different way, but let's see what comes up here first. So the percentage change is equal to 3,886 minus 126 divided by 126 is going to be an enormously large number. But that, and then times 100, we move the decimal place over a couple spots to get it as a percentage change. 2,984%. You guys get that? You had to slide the decimal place over a couple spots to get that in percentage form. So 2,984% is how much your money went up by from that single time up to here. So a 2,000% return, if you were to put 10,000 bucks in, how much money do you have? So take 10,000 times point, I'm sorry, not times the 2,984.00. So now we're going to move the decimal place back. Well, no, this is already back. So yeah, dealing with such a big number here. How much is your money worth? With a 2,000, 3,000% return. I know a doubling would be 20,000, by the way, right? If it was a 100% return, which is pretty good, 100% return makes 10,000 turn into 20,000, just to give you a hint. Right? So you're doubling it. If you do it times 1, $29 million. Piece of chunk of change. So we want to be able to be in this stuff for the long haul. This is the top 500 companies. You're not, and the reason I bring this up is that you're not gambling any longer. So as you look over a long enough time frame, the year-on-year compound interest, not this way. This way, by the way, is just taking a boom to boom over this over a 40-year time frame. That's not the same as what we've been doing, like getting a 12% return on your money or a 10% rate of return on your money. But it turns out this is, at different periods, depending on which time you take, about a 10% rate of return on your money. So you can get anywhere from 8 to 12%. Again, and sometimes, like if you take this little chunk, it might have been a 20% rate of return, right? If you take this little chunk where it went down real quick here, that would have been maybe a 3%. See what I'm doing here? So depending on what little slice of time you take, if you went from here to here, you made nothing. With me? So that's like 0% from here to here. Even though the market went up and down, you didn't sell. So you, on average, got about a 0% rate of return. And so depending on where you calculated, so we want a long enough time frame so that we're getting all of that rate of return. Okay, questions or comments there? All right, so now back to your papers. On a scale of 1 to 10, how comfortable are you with risk? So this is a personal question. Everybody's going to have a different answer. I'm going to go survey around the room. What you guys are thinking. Scale of 1 to 10. So put down a number here. How comfortable with risk are you on a scale of 1 to 10? Are you a 5, a 3? You don't like risk? If you're totally insane with risk and you just are some sort of strange person, you might put a 10. But just kind of where on that scale of 1 to 10 are you with risk? Okay, so I'm going to walk around the room. If you can point to your number with your finger, I'm going to read off people's numbers. So point to your number with your finger. I'll start at the back here. So point to it so I can see it good. 7, 6, 7, 5, 4, 7, 7, 7, 5, 6, 5. And Samad, what do you got? You can unmute if you want.
6.
6. Okay. So when we think about risk, most people are what economists call risk averse. Like you want to avoid risk, right? Kind of tend to go towards the safer thing. And so any particular stock that you look at, especially on a short time frame, is very risky. And so people have the perception of it being a risky thing to do. And so what that leads them to do naturally is to keep maybe too much money in like a certificate of depression that we talked about, the certificate of deposit, something that, well, I know it's going to be safe. I know I'm only earning a 4% rate of return, but I know that it's going to be there when we're done. So a 4% rate of return versus an 8% rate of return turns out to have a pretty big difference. And so that's the importance with this risk stuff. Let me, I'm liking this financial mentor calculator. Okay, so you start with nothing, and you put away $200 a month, and you earn a 4% rate of return, keeping your money pretty safe. And you do that for, let's do 30 years this time. Well, I guess blow this up a little bit. So what do I get? So 4% rate of return gives me $139,000. Not terrible, right? That's something. I've been putting in $200 a month for the last 30 years. Notice that I put in $72,000 worth of my own hard-earned money into that investment, right? So I put in $72,000, $200 times 30 years, $200 times 12 times 30 is $72,000. And I've earned $67,000 of interest. Not too bad, almost the amount that I put in. So it's like I almost doubled my money in that sense, right? So if I change that to 8%, what should I expect here? 280 or so? If I put in 8%, double my interest from 4% to 8%, I'll leave all the other variables the same. Double that, 280 then, 140 plus 140. Let's check it out. So instead of 4%, all I'm going to do is do 8%. $300,000. Now, look at what happened here with the interest earned. So I went from 140 and I added 160. I more than doubled it. And I earned 228,000 on my 72. What's starting to kick in once you have more interest that you buy? Compound interest is kicking in. So if I double it again, let me just add go to 12% here, another 4%. Now look what happened. More than double, right? You start to see the hockey stick now. So on the graph, what that looks like is this. And so we need to be getting rates of return in that 10% range. You need to put your money at risk. We need to overcome our aversion to risk through knowledge. Because what we're going over here is not very risky if you do it right. What was the D word again? Diversification. So if you diversify, then you're going to capture this picture, where over a long enough time frame of 30 years, you're pretty much very, very likely going to earn 8 to 12% over that time frame. Questions? Yeah. Next to nothing. So Hannah's question was a good one. What are the requirements to get the S&P 500? So where we're going into this rest of this chapter is with mutual funds, and then there's also some other things that you can buy called exchange traded funds, which is buying essentially the S&P 500 for very cheap. So and I don't want to jump too far ahead, but you might be able to buy the S&P 500 for $40. Like literally pull $40 out of your wallet, and you can own the S&P 500. Of course, you want a very tiny, tiny, tiny fraction of all those companies. If you were to go out and buy one share of each one of those 500 companies, it would be very expensive, probably be $20,000 just to buy the one share of each of the S&P 500. I just totally made up a number, but it would be, one share of Apple might be $300 all by itself. And then so you start buying a single share of all of those, and it's going to be very expensive. So these mutual funds, end up being financial instruments that allow you to buy it all in one shot. You're essentially buying what a broker has put together. They bundled the 500 together. And it's actually a great way to do it because the fees are really cheap on that too. Okay, good question. Anybody else so far? All right. Back to this tab. All right. Yeah, we don't need to jump down too much there, but all right, that looks good. Let's go. So you were asked to finish video 2 on your own as homework. And part of that was, why is it important to understand your investment decisions while you work with an investing advisor? Why is it important for you to understand? This is kind of the highlight of this question that they emphasized in the video. Why is it important for you to understand your investment decisions? Take a couple minutes and write. I want you to write a paragraph on that. Okay, hand a number between 4 and 8. 1, 2, 3, Raven. That's a good question, Hannah. Yeah, you very sharp, Hannah. Raven. 4 and 8. 4, Michael.
I said
basically catch that.
I said basically, if you don't know what you're doing, it's basically like giving your investment advisor the money to do whatever they want.
Okay. And why would that be? Would that always be bad?
Because you don't know what you're risking, really. Like,
Okay.
it's basically like playing a video game with real life money. Like, you don't know what you're doing.
Okay, good. Anybody else want to add on to that? What else do you got? 1, 2, 3, 4. Gunner. Why would that be important? Okay. So here's the thing. You guys are saying the right thing. In economics class, we have this issue called the principal agent problem. You are the principal, actually, in this arrangement, and you're hiring somebody to manage your money, right? And so sometimes it's possible for the agent to not have all of your interest at heart. So have you guys heard that, or do you guys know that sometimes these guys earn commissions? So if they put you into a certain investment, they might make more money than if they put you in another investment. And you see the conflict there, and a conflict of interest where the commission's higher on this particular investment, so I might be a little tempted to put more of your money there, even if it's a little too risky or not risky enough or whatever the case is. They have a higher commission. So Dave's recommendation is to find an investment advisor that is a teacher, essentially, that they're willing to sit down with you and explain some of the stuff that we're doing over in class. You guys are getting an exposure to it now, and hopefully some of this stuff will stick. But one of the reasons I want you guys to have this book or something physical is when you get to that first job 4 years from now, and you're like, oh, I gotta pick my 401k at my new job. Oh, I remember McCullough had some great stuff to say in personal finance class. I wish I remembered what that was. You kept this, you dusted off. After you've moved 5 times, you kind of kept the book, you open it up to chapter 10, and you figure out what you should be investing. It's that simple. We're really going to make it simple. It's not going to be a bunch of stuff that's hard to digest. It's going to be pretty simple stuff. So he opened up this chapter with keep it simple, stupid, right? And so the KISS principle is the principle I even follow. And I have a PhD in economics. I know this stuff really well. I know how options and calls and all that stuff work. And that's why I stay away from it. So keep it simple is an important part of this process. All right, so on your notes here, I'm going to introduce you to this mutual fund concept. So we've got single stocks, and then we have these other investment things called mutual funds. So one example of a mutual fund, is a company that mutually funds investments of diversification with investor money. And by investor, I don't mean Wall Street, I mean your money. You are now the investor. I want you to, even though most of you might be scrapping to put a couple quarters together, we're going to look beyond this. This is long-term stuff. All right, so for example, I'm going to talk about a company called Vanguard. So example, Vanguard is one mutual fund. Let's just start calling them an MF. Hopefully your mind won't race to profanity, but one MF. Vanguard is one MF mutual fund that mutual fund company that offers over 100 options for mutual funds. So example, so I'll show you guys this here in a second. What's the trading symbol? BFINX. BFINX is the trading symbol for their mutual fund that follows the S&P 500. Kind of similar to what we just talked about. Okay, so suppose you invest $100 into the FINX. So what are you buying? So here you're going to buy BFINX, and you're going to buy $100 of that fund. And BFINX has 500 companies. We're not going to list all 500, but one of the companies you're buying is Apple. And one of the companies you're buying is Home Depot. One of the companies you're buying is McDonald's. One of the companies you're buying is Coca-Cola. And maybe we'll throw some Pepsi. And of course, you've got Facebook. And you've got Netflix. And you got Microsoft. Okay, then you got a bunch more. So what Vanguard, the company, has done is it's built a portfolio of holdings of this, and they have 5% Apple, 2% Home Depot, 1% McDonald's, 2% Coke, only 1% Pepsi, 4% Facebook, 4% Netflix, and 3.5% Microsoft. So from your homework on Sunday, what was McDonald's selling at? What was the price? Do you remember? McDonald's price? You did so many prices, maybe you don't remember. much does it cost to buy a share of Mickey D's? Anybody remember? I'll look it up real quick if nobody's remembering. Oh, stop. 211? 211. All right. Now you didn't Google that, did you? Yeah, you're not supposed to do that. So you're gonna lose a point for that. But thank you for looking at it. Remember, stay off your machines. Even if your computer's there, unless I say you can search, I don't want you on other places. So, okay, look, you lose a point, but that's okay. You're doing good anyway. You can make up that point easy. All right, so 200, that's why I was doing it. 211 bucks. So if you want to buy a share of McDonald's, you'd have to fork over $211 to buy one share of Mickey D's. So by buying BFINX, how much of McDonald's is now in your portfolio? If this was your first purchase, like Hannah was thinking about, how much of McDonald's do you own? 1% of total McDonald's? I want a dollar value. You just put in, you just bought this thing, this financial asset, a mutual fund. You just spent $100, and this is what it's holding. How much of McDonald's do you own right now? $1. You literally just invested $1 into McDonald's. That's the power of the mutual fund, is that you, as a small-time investor, can buy big-time companies with a little bit of money, right? So you now own $1 of McDonald's. So if you start thinking here, your $100 now turned into $1 worth of McDonald's, $2 at Home Depot, $5 you just invested into Apple, $3.50 went into Microsoft, $4 went into Netflix, $4 into Facebook, $1 into Pepsi, $2 into Coke, right? All with that simple little $100 investment. Are you diversified? Even your little $100 is well diversified, right? So it's a real powerful tool to be investing in, and it gets you all the things that you need so that you can live your life not worrying about your investments and just kind of keep putting in $100 a paycheck, $100 a paycheck, $100 a paycheck. Go live your life. Go fishing, go hunting, go to school, watch your kids, do your job, whatever it is, and you can put this on autopilot, literally. Once you've done your homework ahead of time, and your investors have kind of taught what your taught the things, some of the basics, so that you know your money's at play. Basically, what we're doing in this class, you can have it on autopilot, and you can have that $100 grow into $1 million over the next 30, 40 years. Okay, Hannah, you look like you had a questioning look. Are you good? Any questions? So good question, leading right into it. So what it means is that the S&P 500 has the breakdown of different stocks, and sometimes stocks go up and down, and so the 500 actually changes hands, and so the broker has to try to, they're just following the S&P 500, and so the S&P 500, remember, is done by a different company. They just take the top 500 stocks and then they publish it. So, and they publish it every, I don't know if it's every month or what it is. So here, this is the real, blow this thing way up. So this is the real S&P 500. Let's see if I can get rid of this box here. Let me go. Too big. 300% is too big. All right. Whoops. There we go. So the blue is the index fund investment. This is the actual S&P 500 index. So there, notice that it's not perfect, but about the same, because the investor has to like sell some shares, buy some shares to try to mirror the S&P 500. But what the Wall Street Vanguard company is doing is making those trades as soon as they know the information is there. And so over the 5-year period, 15%, 14%, 18%, in the last year has been real strong. And then since its inception in 1976, they don't have the data for the S&P, but this fund has been in place since 1976, they've gotten 11%. So when I say that you guys can get between 8 and 12%, here's some data that says I'm not kidding. I'm not just making that up, right? This is actual real world data of what you can do. And so even the last 10 years, you've done 13%, higher than what the 8 to 12 that I think we should have for a reasonable expectation. Okay, questions or comments there? So this actual particular fund, this is the, let me scroll up to the top here. Let's go ahead and, let's see, where did we leave off? It's Michael, Caleb. Caleb, why don't you read this paragraph for us? Okay, so this is going to be part of our portfolio, 25%. I'll just kind of cut to the chase. So the next video, again, I think it's the video after that, we're going to learn what percentage we're going to put our portfolio in. We're going to have 25% of our long-term retirement into large cap funds. So you're going to hear Dave say large cap. Those are big companies, right? The biggest companies. So this could be an investment that you could put 25% of your holdings in. Then we're going to put 25% into mid-cap funds, which is middle-sized companies in terms of their capitalization. And then small cap funds are going to get 25%. And then 25% is going to go to international. We'll get a piece of the globe. And that's it. That's going to be kind of our whole overall holdings. And this could be one of those investments. So I put my parents into this Vanguard group years ago. And it's worked out pretty nice for them. They're both 72 now, I think, 71 or 72. Here's the top 10 that they have. So Apple, Microsoft, Amazon. What's Alphabet? It's something you know, but it goes by Alphabet on it's their official thing. It's Google. So Google is Alphabet. Facebook, Tesla. Kind of surprising, but Tesla has gone crazy here the last few years, especially. Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, and Visa. So those are the top 10 of the largest holdings, and that's how they're ranked in the index as well. So they're just ranked by what size they are. Okay, so that is Vanguard. Here's a kind of so risk potential. Less risk, most risk. It's a number 4 still, right? But again, diversified for a long period of time. You don't want to jump in for a short period of time. It becomes less and less risky as you widen the time frame. All right, I think we're ready for our next video. Sir, any questions? Yeah.
What's an RTF?
So an ETF is an exchange traded fund, and I'm not sure RTF. Did you see RTF up there?
No, I just.
Okay, ETF is exchange traded fund. It kind of is like it can be like a mutual fund, and it's pretty easy to get in and get out with it. So it's very similar. It's kind of a new innovation that's been around for the last 5 to 10 years. It basically takes smaller bite-sized pieces. So this one, it would cost you $361 to buy 1 share of this. With the ETF, you can buy the $100 share. Kind of long story short, you can buy little chunks. Can be broken up into smaller pieces. Okay, anything else? All right. This one. Okay, what I want to do first is work with your neighbors there. Let's say you're kind of on your own island. You can kind of go over just take a couple minutes. Want you to pool your brains together and fill out that Venn diagram. Put as many things as you can. Just kind of look at other people, talk about things that stand alone. Samad, this is the Venn diagram that I just passed out. It's one of your handouts, but it could probably be easier for you to just draw it on a piece of paper if you want. And just draw the 2 circles. It says single stock and mutual fund, and then the middle is what they share. So go ahead and take a couple minutes, get that filled out. This will be turned in for points. Okay. What do you guys have in the shared section? Give me one of yours. Okay, both of them you're investing in stocks essentially. Good. Give me something on the mutual fund side.
Group of people.
What's that?
A
A group of people rather than going solo. Good. And why don't you guys give me another shared one? What's that? It all has some type of risk. That's a good one, Raven. Yeah. So you don't have to even write these down, but here's some of the things from the shared. I just want you guys to be thinking. So you got the single company. You might be having to work through a broker there. Over here, this is some things you wouldn't have put down, but 100% of 10-year period has made money. All mutual funds, that's saying something. If you look at them over a 10-year period, remember when I was blocking off the time period, like 10 years here, 10 years here, 10 years here, 10 years here? 100% of mutual funds over a 10-year period have made money. So you're not going to lose your money. In fact, you're probably going to make lots of money because even any one particular mutual fund, and by the way, there's like 9,500 mutual funds out there. I haven't Googled it recently, but around that. So there's tons of these options. I just gave you Vanguard, and I just gave you one of their options, but there's tons of stuff out there. So good. So that gets our juices flowing here. So I wanted to go to your investment scavenger hunt, which some of you didn't do yet, so you can still turn it in late for 80%. That was due last night. And so you were to go through and look at different investments. And so the highest rate from a certificate deposit, highest performing mutual fund average over this. So you're basically going on Google and doing this. I've got Brady's up here because you had kind of nice put together. And just so you know, Brady, you know you don't have to like type this in and be formal. That's one of the reasons I chose yours. It's okay to handwrite them in if it's easier, but if you know whatever your technology or technology skills are, you can do it all nicey like Brady did here, or it can be just your handwritten ones is fine too, with a PDF. Okay, so what's fun with this, I enjoy doing this each time, is I have Taylor's paper from the class I taught in November 26th of 2012. So Taylor did this exact same exercise. So it's kind of fun to go back with Taylor. It's not this Taylor. This is Taylor from 2012. So this is over 8 years ago. 8 years ago, this is a different student I had in the class 8 years ago. And so, you know, the 1 year rate on the bank rate was 1%, 1.04. We're not going to do all of these here, but here's your small cap funds. So mutual funds that we're looking at. And the rates of return. So here, Brady, you had a small cap fund that was a 40% rate of return. So we're going to have 25% of your long-term investments are going to be in small caps. Some years it's 40%. Let's see, what did she have? Taylor had 17%. I've done it in other classes where it was minus 12%, by the way. So that one can be minus for small cap funds. Depending on which one. So 40%, 11% return on that one was a 12%. Oh, here was this one was the energy fund. This was the worst fund, I think. Is that right, Brady? Do you remember? Vanguard? Yeah, so the worst mutual fund, number 5. That's why I usually like keeping this. Lowest performing mutual fund for the past 10 years happened to be a Vanguard product. There's your Vanguard again. So negative 5% return was the worst performing one. Taylor's was negative 33%, was the worst performing mutual fund. Remember, this isn't a single stock. So the mutual funds, as Raven pointed out, they have risk too, but we're using this diversification strategy and spreading our money out. Gold is a terrible investment. Don't go into gold is what Dave's going to say, and what Russ is going to say. So it was 1791. Which is funny. Taylor's 8 years ago, it was $1,729. So just a little bit up, pretty flat for gold. And gold kind of fluctuates, and people get in and out of gold for stupid reasons. So don't invest in gold. Is the short of the story. And then there's lots of good reasons behind that. So 2001, of course, that's the same. Yesterday, oil 59.25. 8 years ago, you think oil's higher or lower? Lower, oil, 8 years ago, $87.68. So oil prices were a lot higher back then. And then we get into these companies. Let's go to McDonald's here. McDonald's high was at the 52-week high. So 1 year high for McDonald's. Let's see, am I off the screen here? There we go. 229 is what Brady had. 102 is what Taylor had back 8 years ago. 102 versus 229. So 8 years went by, it more than doubled. From 102 was the 52-week high for McDonald's. So if McDonald's was part of your portfolio, which it would be, if you're doing the investment plan you got here, you would have done pretty well. Walmart's 52-week low, 102. Taylor's 8 years ago, $57. So even the low of the low for the year, Walmart almost doubled in price from the low. Coca-Cola, $50, $37 for Taylor's paper 8 years ago. The treasuries are pretty pathetic. Both sides, 0.66 for Taylor there. International fund. Wow, okay, this one's a good one to look at. So Brady came up with 47% on the international fund, right? So you're investing in companies around the world. Taylor's 8 years ago, 5.66. 5.66. So you see, you can have a heart attack if you're kind of watching it every day going up and down, like, oh, it's 5%, should I move my money around? No, don't move your money around. Put in $100, go live your life. Put in $100, go live your life. Put in $100, go live your life, right? Stock market's going to do this. Don't have a heart attack because you're in it for the long haul. Because by the time you get to baby step number 4, what else do you have with baby step number 3? 3 to 6 months of expenses for an emergency fund. So you don't need this money because you got that money as part of your overall plan. Small cap fund, I assume this is 37%. You put 0.37, but I'm guessing it's 37%. I think it was small caps. Taylor's was 3.74. So the market must have been down 8 years ago when Taylor did this roughly. And then we've got the 1 year return, 17 and 14. This was 35% for Taylor. Somebody hit it big. And instead of 14, it was negative 2.63. So it's kind of eye-opening that's why I really like this investment scavenger hunt. There's tons of financial products, lots of places to put your money. We're going to give you 4 places to put your money. But you're putting them in some pretty big places, and you're actually grabbing the whole market. You're really grabbing the whole market with the strategies that you're going to learn in this class. Okay, questions or comments there? All right, so let's flip over your paper. This was your other thing due last night. And I'm just going to have you pencil this in. So what do we have here? We've got, go to the investment calculator. I'm going to use the financial one that we did, but the other one works too. If you invest $500 per month during your entire working lifetime, age 25 to 65, so we're going to use 40 years, what do we get? We're going to get $1,000 starting. So you guys are going to get good, hopefully, at using this financial calculator. Put in $500 every month. And what's the first interest rate we're going to use? 8%. So that's kind of the low end of the recommended. And we're going to let it go for 40 years. There's your number. 1.7. Go ahead and fill that in. That amount, $1,000, $500 a month. Do some people have $500 a month car payments? Some people? Yeah, you betcha. Go out and buy yourself a $40,000, $50,000, $60,000 car. Maybe it's a lease payment. There's people out there, a lot of people drive around a $500 car payment. Instead, do what we do in this class, $1.7 million. And look at the compound effect here. 241 was the total amount of money that you put in, and you had money on top of money, interest on interest, the compound interest of 1.5 million. All right, so this is going to get really bizarre here. What's our next interest rate? 12%. Now, we just saw that the 10-year was 13%, remember. So this is not impossible, even doing this strategy. $6 million. $6,059,000. The rest you can kind of leave out for zeros for this exercise if you want. $6 million. So we went from, what was the previous one at 8%? $1 million. The compound interest thing really kicks in here. Check this out. You still put in 241,000, but now you got 5.8 million worth of interest on interest on interest. It's important to leave it in the long haul, getting the right thing. Okay, now this one's just going to get bananas on us. What's the next interest rate? 15%. Is it possible to get 15% in a given year?
Probably.
Yeah, no, more than probably. You can look back at the record. Brady's stuff that he just did showed that you can get, over a short window, you can get 15%. The longer window, it's a little less likely, but possible. $16 million. You still put in 241, but now you got 15.8 worth of interest on interest on interest. That is how you become a millionaire. Don't get a car payment. Put the amount you would have gotten in a car payment into this. You do that one step and you're almost there. You're almost there on that one move. All right, adios. See you tomorrow.